Hello, and thank you for tuning in to the very latest episode of Mortgage Matters. I'm Andrew Overman, and this is...
I'm Michael Webb from Mortgage Republic.
And together we navigate the minefield of the mortgage market and answer our audience questions on a weekly basis. And this one has got people in a real stir, Michael, because there was some media speculation, scaremongering, call it what you will, that mortgage affordability rules are changing this week. Or changing imminently, sorry. And there was concern that would lend to frivolous lending and, the kind of scenarios that we saw with the, together mortgages with Northern Rock at 100% of property value, 25% unsecured loans, and everything that we saw in 2007 and 2008. So our question from our viewers this week, and there were several, is how are mortgage affordability rules changing? Over to the expert.
Yes. So this is a great question, and it has been across a lot of the mainstream media, definitely across a lot of the industry press. So the Financial Policy Committee kind of meets to review these things, and basically there's some regulations that came in 2014, mortgage code of business, EU credit directive came in 2016, things like this that regulate how lenders can loan, and they have affordability tests. And the thing that's changing is the dropping of the interest rate stress test in the background. So a lot of the questions that we always see, especially on social media, is, well, how come I can pay £1,200 a month rent, but I can't get a mortgage that costs £800 a month? Well, The reason for that is you're seeing a mortgage at £800 a month based on a 1.2% interest rate, and the lender needs to make sure had to make sure that was affordable at 6% interest rate, which actually gave you a payment of well in advance of your £1,200 a month rent. And obviously your rent's fairly stable, may increase based on RPI and what the landlord says, but obviously interest rates can go all the way up to, as we've discussed in previous episodes, 15-16%. So they need to make sure there's an overriding affordability. They are now looking at dropping. The recommendation is to drop the stress test on the affordability. However, they're not dropping the responsible lending requirements that are in the MCOB rules, so the Mortgage Code of Business rules, that's within the FCA handbook. And they're also not dropping the aggregate lending regulation of 4.5 times income. Which basically, now that's not saying that that's all they'll lend an individual. That's saying that as an aggregate across their mortgage book, they should not be lending more than 4.5 times income.
And that's presumably to negate overexposure of the banks, so we don't see the banking infrastructures collapse as they did in 07 and 08.
Yeah, so there's other like liquidity rules in place where for every pound they lend, depending on the loan to value, they have to have capital adequacy of X amount. So if they're lending at 95%, for every pound they may have to put a pound into savings, and at 60% they only have to put 10 pence. But as an aggregate, it needs to make sure there's capital adequacy across the bank so that it doesn't go, hang on, we've lent all our money out and we haven't got any in reserve. So these regulations were brought in post credit crunch.
Okay, so just for the average Joe on the street like myself, isn't it a bit of a strange time to relax the stress testing when we're seeing the cost of living rise exponentially and an upward trajectory of interest rates?
Maybe it's coming in. Yes, sorry for talking over you. It's coming in August this year. This removal of the stress test. The concern is the stress test is set at a level above certain rates, and if those rates are going up, then you have the issue of kind of that stress test could go too high, and then all of a sudden what's left behind is not a real ability to lend or lend at a level that's capable to support the current house prices. So again, there seems to be some manipulation there. I don't see an enormous change in what people are being allowed to borrow, because the affordability rules are still there, in that you've got the responsible lending regulations. They're not changing. The lenders are already set up for that. That responsible lending typically ties in with things like ONS data, which is plugged into their affordability calculators in most cases. And that ONS data is factoring in ridiculous inflation at the moment. So we're already seeing lenders saying they're not going to lend as much as they were 6 months ago for people if you took someone in the exact same position. So, and obviously that's magnified at the lower salary level. So if you're putting in £100,000 into a calculator as salary, that will be affected in a much less situation if you're putting in £20,000.
Of course. So I mean, do you see this as a mechanism that will naturally curtail property prices? Because if properties are becoming, I suppose what I'm getting at here is if they're removing an element of the stress test that would make it harder for more people to obtain borrowing, which would then naturally, I suppose, suppress the market in terms of prices, maybe bring some normality back into the market in terms of supply and demand. If that stress test is being removed, aren't we potentially exasperating the problem? Or do you feel confident that with the other mechanisms in place, we are starting to see lower salaried removal from the market? Because I'm not seeing that at the 250 average house price bracket here in Thetford at the moment. With the number of people booking onto launch, I would say, in fairness, they're probably 20% down year on year.
Okay, so my opinion on this, and it is only opinion, it will depend on how things play out. I don't think it's going to make a difference at all. I think even if you read the Monetary Policy Committee kind of press release, as I have, it kind of suggests the lenders are set up for these changes and it's not going to make much difference, but they're just removing this element of stress testing at an interest rate. I don't think it will all of a sudden go, oh, you could borrow 200, now you can borrow 250. I don't see that. But touching on what you've said about the general market, if you look back over the 5 or 6 years, there's been opportunity for the market to the house price market to kind of reset itself and drop a bit. And the current kind of government,
Brexit, COVID, lockdown 2. I mean, they were
none of it's worked. And the current government does not want it. It feels, this isn't a political statement, it's an observation of what's happened. It feels like the current government does not want house prices to adjust down. They'd probably be quite happy for them to stagnate, but they don't want a house price readjustment or crash. That's not a particularly good political thing to occur going into an election, whenever that will be in the coming years. Or
a leadership election.
Well, maybe. And they don't, everything they've done has been to continue to push prices forward. The stamp duty exemption was the biggest boom in the property for such a long time, because it dragged so much business forward from future years, and the demand was incredible. So nothing that's been done has actually stopped it. You look at Help to Buy, that boomed prices. I mean, new build companies, they'll tell me I'm wrong with this, but they went, well, hang on, you're getting a 20% discount because the government's paying it, so we'll whack the prices up 20%. It's exactly what happened. If you look at it historically.
That then respills off into the resale market. So
exactly,
if you look, 3 years ago, you were buying a 2-bed on Cloverfields here in Thetford for 150. What are they now? 200k.
Yeah. So everything they've done has propped up and driven the house market forward. Now, the argument to that, from their point of view, is stamp duty is one of their largest income drivers. So if the property is more expensive, they are taking more stamp duty. Yeah. And again, I'm trying not to make this political, but fuel prices locally to us have gone up 6 pence in the last 48 hours. I have no idea what's happened in the fuel markets to drive that. However, what I do know is that revenue to the government is in the tens of millions a day from these prices being high. So overall, it matches like the property market. Why would they want prices lower? If prices are higher, estate agency fees, if they're a percentage, are higher, which means VAT is higher. Everything is higher. There's an argument, if you want to be really cynical, that inflation at the level it's at is really beneficial for a government that has printed and borrowed significant levels of money, because it is compounding its value downwards.
Yeah, I mean, very true. I think, well, we digress a little bit. If you look at the price of crude oil and you look at it pre-COVID per barrel, you look at it now, they are very similar levels, yet we are paying a good, 40% more at the pump. So
yeah, well, in the middle of lockdown, prices went below £1 for
for the first time in over a decade.
Because no one was able to buy it. No one needed it. So the demand dropped. It's double that now.
So in essence, mortgage affordability rules are changing, but not to the degree that is being scaremongered. There is a removal of an interest rate stress test element, but there are other mechanisms in place to prevent frivolous lending and a return to 07, 08 and the awful.
Yeah, I mean, you mentioned the Together mortgages, and I'm fairly active across social media and looking at especially the news articles and things like that, and hence a lot of people say, look, there should be if you've paid X amount of rent for whatever time, you should be able to take a mortgage for that amount. And in logic, that kind of makes sense, except that your mortgage payments can become much more expensive, even if you're fixed for 5 years. You're taking a 30-year mortgage contract, 25 of it's variable via the contract. So, but you mentioned the Together mortgage, and I found it really interesting because a lot of people like, oh, well, the solution would be, and they just described the Together mortgage, and they were people of an age that were too young to know what a Together mortgage was. And I was like, this is what caused 2008, or an element of it.
Yes, absolutely.
And they were like, they couldn't quite buy into that they were just going to create another problem.
Well, it's a really interesting discussion, and I know this is fluid, and the rules are changing in August. So I think it would be prudent for us to catch up around that time and record a follow-up episode to release to our audience to see how, if at all, the market has changed in that period, and whether the removal of that particular element of the stress test has affected mortgage affordability and the criteria that follow. I think that's all we can do. But for now, Michael, thanks ever so much for cutting through the noise and giving us your honest verdict as to what's actually happening, and a little bit of calm and normality within the media hype that's going on at the moment. So once again, thanks for watching. If you've liked the episode, please don't forget to hit the subscribe button and share it across your social platforms if you think peer groups would benefit from it. But for myself, Andrew Overman, and my friend Michael Webb, thank you for watching. Take care.
Thanks very much, Andrew.